Hi, this is the second task of the first AAT FAPS exam. So I'm just picking up where I left off. So I answered that one. I'm now on to the second task, 14 marks, about recording period end adjustments. Interestingly, AAT have just issued a very brief examiner's report in which they say that task 2 and 3 are the weakest links. So one to really concentrate on. Right, let's have a go. Alice owns a business which provides cakes for corporate clients. You are preparing her year-end accounts. She is registered for VAT. Identify which one of the following should not be included in the valuation of inventory at cost. Right, so buying in the ingredients, definitely part of the cost. Carriage inwards on the ingredients. So the cost of getting your raw materials to you is part of the cost. So that's not the answer. The labour costs to cook the cakes, that's also part of the cost of making them. But the refrigeration cost for their storage is not part of their cost. So that would be the answer. An accrual should have been made for rent. Identify how the following elements are affected by this omission. Right, so if we haven't put through an accrual for rent, so just think about what the double entry would be. We would go debit the rent to bring in more expense. So if we're bringing in more expense, then our profit would obviously come down. So at the moment, that means that if we haven't put through this adjustment, our profit must be too high. Because basically putting through the accrual would bring the profit down because we'd be bringing in extra expense. So thinking about the accrual, debit the rent and then credit accrued expenses. Accrued expenses is actually a liability, which isn't mentioned here. There's no effect on the assets. So that would be the answer. You have the following information relating to the rental income for Alice's business for the year ended 31st of March X8. On the 31st of March X7, the end of the previous year, an entry of 1,000 was made into the rental income account relating to accrued income. This needs to be reversed. Right, so you can do this by all sorts of methods, but I would be thinking about it logically. So accrued income means that someone, in this case the tenant, owes me some money that they hadn't yet paid. If that was accrued at the end of last year, we would have brought that in as extra income in the previous year. So in the previous year, we would have gone credit rental income, debit accrued income. So now we have to reverse that, which means that our accrued income reversal will be on the debit side of this account. So you could think, well, someone owing me the money is an asset, so therefore an asset is a debit. There's all sorts of ways that you can remember this, but whatever way works for you, make sure you get that reversal. So it's an income, it's accrued income reversal, so it's on the debit side. Cash book entries for the current year are £12,000. All right, so this is our second step. So this is rental income, so cash book entries will be debit the bank, credit the income. So the 12,000 needs to go in there as a credit, with the other side being the bank. So cash book. And then it says this included a receipt. So immediately I see the word included. I'm thinking prepayment. So this included a receipt of 4,500, which related to the 6 months ended 31st of July. Right, so my year end is March. The 6 months ended July will be February, March, April, May, June, July. So that means that April, May, June and July, so 4 out of the 6 months, has been prepaid. So what I need to do is work out what 4/6, because 4,500 relates to 6 months. So I divide that by 6, I get 750. And I've just calculated that 4 months have been prepaid. So my tenant has paid up front. It's included in that £12,000, but it shouldn't be there. So I'm going to debit 3,000. And the narrative for that is going to be prepaid income. I can then complete the rental account, ensuring that the account is balanced off appropriately. So that's a little bit misleading. You might think, oh, I've got to put balance carried down in there, which let's see if it gives you that as an option. Yes, it has, because it's used the word balanced off, but this is a rental income account. So we know that the appropriate thing to do is to send that balance to the statement of profit or loss. So that means that in my account, I would have £8,000 of rental income, which is basically saying, well, it's the 12,000 that you've received during this during this year. However, 1,000 actually really related to last year and was included as income in last year's accounts. And 3,000 relates to next year and therefore will be included in next year's accounts. Right, so we've just got 8,000 for the current year. Right, moving on. The balance on the receivables ledger control account as at the 31st of March is 27468. It is company policy to adjust the allowance for doubtful receivables to 2%. So initially I'm thinking I need to work out 2% of that, but let's go on. The company has only one general ledger account which contains specific and general allowances for doubtful receivables. So remember, a specific allowance is where it's a particular customer. You don't want to write it off as irrecoverable just yet. You still think there's a chance that you're going to get the money. And then the general allowance is what this is talking about. We don't know who it is that's going to go bad, but we know based on past history that usually 2% does, right? So specific and general allowances. The allowance for doubtful receivables at the start of April X7, so last year, was £558.27. At the end of the year, Alice asked you to make an allowance for a specific doubtful receivable of 2380. Right, so we need to deal with that first. Produce journal entries relating to the allowance for doubtful receivables. The specific and general allowances should be journaled separately. Right, so let's deal with the specific one first. So when you have a specific doubtful receivable, you are creating an expense in your accounts. So we would debit the allowance adjustment. Always remember that the allowance adjustment is the one that hits the profit and loss. So that's going to be the expense. And then we will credit just the allowance. Right, so the allowance is the one that appears in the statement of financial position as a reduction to the trade receivables figure. So we're not knocking it off in the RLCA, like we're still saying, no, we want to show that this debt is still there and we need to chase it, but we're being prudent in our accounts and basically reflecting that we don't think that we're going to get that money. Right, so I've dealt with the specific allowance. So now we need to calculate the general allowance. Right, so what we need to do then is we start with the 27468. We subtract that specific allowance that we've just adjusted for, because what we don't want to do is find like allow for it in total and then allow for another 2% of it. So we take off that 2380 from the 27468. So I've got 25088. I then find out what 2% of that is, which is £501.76. So that's what I want my general allowance to be. At the moment, my general allowance is sitting at 558.27. So I need to reduce my general allowance. So I'm just going to find the difference between what I want, which was 501.76, and what I've got, which is the 558.27. So that's a difference of £56.51. Now I'm making the allowance smaller. So therefore, the allowance itself needs to be debited to be made smaller. And then the allowance adjustment will be a credit, because actually it's like good news for my business. It's like a form of income, would actually be shown as other income in the statement of profit or loss, because I have reduced my general allowance for doubtful debts.